My name is Ottaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. This is the eighth of a series of short videos dealing with subjects covered in my recent book, Climbing a High Ladder: Development in the Global Economy. Today, we approach why and how central banks' functions can relate to climate change issues. Starting with an observation about the evolution of global average temperatures. In the last years, extreme weather events associated with climate change occurred in all inhabited continents. Floods, violent storms, droughts, and forest fires, and other types. According to a report by Christian Aid, in 2018, at least 7 cases damage exceeded $10 billion each. So regardless of lingering skepticism by some about the extent to which human action is responsible for global warming, the fact is that the average global temperature at sea and on land has been rising since the 70s, with a greater range of variations and extremes, as you can see in the chart. The chart also shows how the global average temperature has been rising relative to the last 2 decades of the 19th century. As a result of the rise in temperatures, we have seen that extreme weather events have become more frequent. The chart shows the global increase in natural catastrophes, while this one shows the higher proportion of insured losses since 1980. Most central banks are now proposing to consider climate change issues as relevant to their functions. Last December, the Federal Reserve Bank announced that it had formally joined the network of central banks and supervisors for greening the financial system, a network with more than 50 central banks created in 2017 for mutual consultation on environmental risk management practice and those associated with climate change. Christine Lagarde, president of the European Central Bank since November 2019, also stated that climate change policies would be a crucial mission during her mandate. There are 3 possible justifications for the engagement of central banks with the issue of climate change. Risks to financial stability, the impact of climate change on growth and inflation, and the use of central banks' firepower to mitigate climate change. The first and most obvious is the set of risks to financial stability potentially brought about by natural disasters. This is particularly the case for financial sectors, including banking and insurance. According to a report by the Institute of International Finance, more than $2.5 trillion in global financial assets in 2016 were subject to some kind of risk derived from the impacts of climate change. Climate-related risks are a source of financial risk, and it therefore falls within the mandates of central banks and supervisors to ensure the financial system is resilient to those risks. It is worth distinguishing between 2 types of financial risks in this context. First, there are the physical risks, that is to say, threats to the value of assets resulting from climate shocks. For instance, the most intense and frequent extreme weather events, including floods, droughts, hurricanes, and other types of storms. And also the risks associated to trends, including rising sea levels, rising temperatures, and melting polar ice caps. Such physical risks include potential direct losses on assets and also their indirect impacts on global value chains and repair costs. There are also the financial risks arising from climate change mitigation strategies that may be implemented, called transition risks. The move to a low carbon economy will change the allocation of resource, the technologies in use, and the construction of infrastructure. So the strategies adopted will have consequences for the value of company assets. Just think, for example, of the effects of possible carbon taxes or of the acceleration of the transition to renewable energy on resources and activities that would be directly impacted. Let me offer you a snapshot of financial risks associated with climate change. Financial physics and transition risks translate into financial risks and contagion through their impact on sovereigns, sectors, firms, and households. It's also worth noting that the risks associated with climate change could also bring opportunities. According to growth model estimates mentioned by the IIF, the Institute of International Finance, a transition to a low carbon economy could eliminate climate damage equivalent to nearly 2% of the GDP of the group of G20 countries by 2050. Also, the Organization for Economic Cooperation and Development, the OECD, suggests that what it calls a decisive transition could raise GDP in the long run by up to 2.8% on average in the G20 countries. The IMF Managing Director, Kristalina Georgieva, during her intervention at the Leaders Summit on Climate on April 22nd, referred to estimates that a mix of steadily rising carbon price and green infrastructure investment could increase global GDP by more than 0.7% per year over the next 15 years. Well, in addition to financial risks and stability, a second reason for engagement for central banks focusing their attention on climate change events is the potential impact of climate change on economic growth and inflation, and therefore on their monetary policy decisions. The European Central Bank President Christine Lagarde alluded in her inaugural speech in 2019 to the possibility of including the impacts of climate change on the Eurozone economy in the institution's models and assessments. Mrs. Brainard, a member of the Board of Governors of the Federal Reserve System, also noted that climate risks are projected to have profound effects on the US economy and financial system. Therefore, it will be important for the Federal Reserve to study the implications of climate change for the economy and the financial system and to adapt their work accordingly. Kristalina Georgieva has also remarked that the IMF is integrating climate change into their annual economic health checks of countries and financial systems. A third area of potential central bank engagement with the issues of climate change is subject to less consensus. It is about using their balance sheets to favor climate mitigation. For example, central banks could give special treatment to green bonds in their asset acquisition programs, previously approached here in this series. That would turn quantitative easing into a quantitative greening, as William Buiter, current professor at Columbia University, has called it. Additionally, central banks can resort to their macroprudential toolkit, also the subject of a future video in this series, to impose additional capital requirements on activities that contribute to emissions. There is an ongoing development of a globally consistent taxonomy of green investments, after which a green Basel framework of bank capital measures would be possible. But regardless of the extent to which individual central banks will take action in the three areas mentioned here in this video, they can no longer ignore the issue of climate change. As noted in this book, The Green Swan, on which we strongly relied for this discussion here, there is a quote, growing realization that climate change is a source of financial and price instability. It is likely to generate physical risks related to climate damages and transition risks related to potentially disordered mitigation strategies. Climate change, therefore, falls under the remit of central banks, regulators, and supervisors, who are responsible for monitoring and maintaining financial stability. The book's title refers to a green swan as an adaptation of the concept of black swan popularized in finance after Nassim Taleb's book in 2007. Black swan events are rare and unexpected events with low probability but heavy impacts, in which are fully understandable only after they happen. By their very nature, they do not fit into the normal and known framework. Well, climate change can lead to green swan events and be the cause of systemic financial crisis. You will find a discussion on the content of this video, that is to say, why and how central banks must engage with climate change issues, in chapter 19 of my book that you can find on those places on the slide. In the next video, we will approach financial globalization. Stay tuned.